both of your presentations and insights. For now, Q&A is still empty. Don't have to be shy. We are behind a computer now, so feel free to type as and when. Oh, there's one. Okay, shall we answer this live? So one attendee asked, is there an ideal strategy or order in which to take loans? So do we take the residential mortgage first, equity up, equity gear up, loan second, then corporate term loan third? So I think this is for Janice.
That's a very, very interesting question. You have done some homework. I'm not sure how you derive this strategy. You could have heard some advice from somewhere. But in general, you would be surprised that sometimes lenders would not approve application if you have no credit history. Zero. We had applications decline because the owner has zero credit history, never taken a credit card in his life, no loans, nothing, no vehicle loans, no mortgage loans, for example. Why? Because there is no visibility on this person's character. Character being the first layer of assessment. There's no specific strategy per se, but I would say that in general, the credit bureau is a very strong indication of your payment ability or your repayment ability. So if you hover between the AABB level for your credit bureau score, that allows you to clear the first hurdle in terms of getting approval. Then you can focus more on your company business side. So I would say that rule number one is you cannot have no credit. I think it's quite difficult for people in Singapore to have no credit, you know. So have at least something like a credit card, for example. Whatever credit that you have, make sure that it is repaid on time, repaid in full. There's history. Your credit bill report will actually show the rating, like your last 6 or 12 months repayment. If it's like AAA, for example, then obviously you'll be paying on time. Then all this will actually contribute to your overall score. So don't take on excessive credit. Have something on hand at least. Make sure you have the repayment. And then look at your credit bureau report. If you're like AABB or maybe CC, that is still relatively quite safe for you to apply for your bank financing. Yeah, so in terms of strategy, in terms of like gearing up, balance transfer, I don't have the specific answer for you, but it doesn't matter. It all culminates back to the same point that your credit bureau overall score is the most important factor.
All right, thank you, Janice. There is another question, I guess, for you again. So for the prior question about loans, assume there's a strong AA credit rating with good payment history in the past 10 years. This is the question, but I assume he or she means that will he still be able to get the loans even if a strong AA credit rating?
Okay, so in general, that is ideal with a good credit bureau score and with good repayment records for both individual and both on a company level. But do take note that there are also instances where some banks may not entertain applications for industries that they want to have lesser exposure to. There is no way to find out this information. I mean, in our course of work, we know. But in general, if you are self-applying, it would be safe or prudent to ask the assigned banker before you submit any documents is your industry an avoided industry for that particular lender? This is information that they would tell you out of goodwill. It's not official. You know, no bank will advertise on their website and say, you know, we're not entertaining applications from this industry. They tell you, yeah, we'll look at it case-to-case basis. But if you are in an industry that is avoided by the lender now, then it don't make sense for you to try your luck to apply with that bank, right? Because you can get declined, and it's not your fault. It's just a general industry exclusion. It's an internal thing that sometimes they do, and then they say, hey, you know what? We're gonna hold back all applications from this industry, for example. That could delay your application process, or they may say, let's just decline all the loans that are from this industry in general. That could happen. And when that happens, then you end up with that record of being blacklisted possibly, or that you have a record of being declined by the bank for this particular application. So other than that, I think in general, based on the bank statements, the return checks that I mentioned about, the credit bureau score, your personal credit bureau rating, and to ultimately check with the lender whether the banker whether is your industry acceptable or favorable to that particular lender that that will be prudent. I mean, it's just extra step that you might want to consider taking to us. It is, and this is also to determine to a certain extent whether the assigned banker that is on your case, on your application, is experienced or not. If you're not sure, you can always feel free to reach out to us for further insights on this matter.
Okay, thanks, Janice. Next on, we have a question for Julia. So, Julia, based on your experience, what are the other sources of financing available if the banks have rejected me?
If the banks reject me, I think outside, well, there are other institutes, they do provide funding for that. I mean, there are crowdfundings, so of course their interest and administrative, they will have much higher interest rates involved. And they also claim that the turnaround times and all this are much faster than the bank. So, well, you can try that if you are so-called desperate. And also, well, I think in a way, depending on your business model, whether your confidence to raise some investment for your business, so that will be another way of equity fundraising. So, but that is something that you have to consider carefully, because bank loan is a bit more strict. Certainly, it's a bit more straightforward, without involving the equity side of it. So, yeah, this is something that I think there are institutes outside. They do provide short-term fundings and all this. Janice, you have something to add?
Yeah, just to additionally add, there are institutions that also can lend against the e-wallets. We have found this out recently. You can check with the non-bank institutions. In the past, they used to do this merchant cash advance where they will put the NETS terminal for the business, and then the lender will lend you based on the takings, and then you will repay using their terminal to make the repayment. So if your collection in the past using your NETS terminal, if your collection on a daily basis is, let's say, $5,000, then they'll calculate and take a portion of that payment made through the NETS terminal to deduct for the daily repayment of the loans. Now, the e-payment wallet, which is like your GrabPay, your FavePay, e-wallets that are used to make payments to the merchants, maybe for example your Grab delivery and Deliveroo, whatever apps that you're using to make that payment, has now become the modern version of the merchant cash advance. So what some funders may possibly provide is that they can fund you against the collection from your e-wallets taking. Because how it works, what I understand is that for F&B, when you get your payments from Grab and FavePay, it's typically not immediate. So if someone pays today using that, then it takes a day or two or something like that before the payment comes in. So what happens is the funder would then control that account. They will speak to Grab or Fave, control that account, review the cash within that takings on the monthly basis, for example, for the last 6 months, 1 year. They will then approximate a loan that they think is comfortable for you to repay based on your history. And then they will deduct a portion as loan repayment on a daily, weekly basis, for example, and then transferring the balance back to you. That means the payment goes from consumer to e-wallet, funder repayment, and then back to the F&B operator. So that's also another option. And why this option is good? Because there's room for negotiation in the case of maybe your volumes get decline in terms of the takings. Then you can still negotiate with the lender, because hey, look, there's visibility, right? This amount is my takings, and it's gone up, it's gone down. You can adjust your repayment accordingly. And another good thing that's also important is that the lender may possibly not take into account your existing loan obligations, because this is actually a charge on your receivables in that sense, and they are the first to be paid above all your other lenders in that sense. So this is a solution that you can look into and maybe speak to some of the institutions and see if they offer this. I'm talking about non-banks, that is.
Okay. Thanks, Julia. Thanks, Janice. I think we have enough time for one last question. I know all of you are behind a keyboard, so you can choose to be anonymous, but it'd be good if you can have some names. So perhaps we could follow up right after this session individually. Okay, so the question is, if the company last year P&L made a loss, does it mean that the company should not bother to apply under the TBL? I would assume will be the temporary bridging loan scheme, even if the government is taking on higher risk. So even if the director's personal credit standing are good, then he has also another added-on question would be the company performance actually improved few months before the circuit breaker, but it hasn't shown yet because it's not the financial reporting period.
I guess this question is for me, right? Okay. Yeah. I shall not review which lender, but there are lenders that can access, I talk about banks, yeah. There are lenders that can access the TBL and WCL, which is the working capital loan applicate assessment, without the need for financial statements. I just kind of reviewed a secret, but so don't quote me on it, but there are lenders, I repeat, that will assess without the need for financial statements. They only look at your credit bureau, they only look at your bank statements. So how do you know? When you check with the various lenders that are facilitating this scheme, check that and find out whether you need to submit your financial statements. If you don't need to submit your financial statements, you have passed the hurdle of not being profitable. So earlier on, whatever I touched upon in my slides is in general. That's the most ideal situation, but it's not possible to be ideal or perfect all the time. So if you see that the lender does not require the financial statements, then the factors which I described earlier about the bank balances, about your credit bureau score, will put you in a higher chance to get approval.
Okay, all right. I guess just nice. We have hit the 1 hour mark. So once again, thank you for attendees for coming, logging in, and also like to thank Ms. Julia Kwok and Mr. Janice Lim respectively. So I'll be sending all of you your PowerPoint slides.
There's one last question.
Oh. Okay, shall we do this? Since MAS, as mentioned, they are lending to banks at 0.1%. So how is the banks lending at a rate of 2 to 3%?
Banks have costs. Their RMs are expensive, their branches are expensive, they send you expensive promotional materials, they do very expensive advertisements, they have their costs. The truth is, this is national service on the bank's part. What people don't understand, I'll take this chance to answer a bit more so that to clear up some misconceptions. We have heard from the ground about, like, for example, this cheap funding and the fact that the government is covering 90%. So I'll take this opportunity to clear up some misconceptions. One is that the capital still comes from the banks. No bank would want to take on an unqualified borrower just because the bank has insured against the default. And the 90% risk sharing only kicks in, let's say in the event of a loan default. The guarantors will still be chased first by the banks. The bank does not absolve the guarantors of the default just because they have covered 90% of the risk. So what will happen is that the banks would chase the guarantor first, and if they cannot recover the full sum, then the government will step in with the repayment. That's what I understand. That's why you sign a personal guarantor. Okay, so it's not that the bank will not chase you. So do take note that this is a loan. It is not a grant, whereby if you don't pay, the government will take care of it on a 90% level, or you only need to pay back 10%, for example. That is not true. As for the cost of funding, which is from the government, the bank has reduced one of the lowest rates that we know in history. It has never been this low for quantums this large. So it will not be possible for a bank to lend out close to whatever they borrowed at. This is more on the government side to encourage the bank to try to make more available capital. But from a business perspective, no bank will take on a financially unviable borrower, because no bank wants to end up with a non-performing loan, the borrower not paying, and then they have loans that they need to chase back. Then they got to go through the process of suing you for bankruptcy to recover the amount, then going back to the government for the balance. It's a very long process. The banks are not keen to do that. They would rather just deal with companies that are qualified. Having said that, if you are qualified, we have seen on instances where you may be able to qualify for more than what you normally should or could in normal circumstances. So in simple terms, the summary is that if you are not qualified, you will not qualify. They're not going to lessen or loosen the criteria just because of this risk sharing. But if you're qualified, it could be possible that you could qualify for a slightly larger amount, case-to-case basis. And our personal take is that our advice is that if you have decided to continue your business, then try to work out what's your cash flow requirements as mentioned by Julia, to calculate a burn rate for at least 1 year, and then to take the financing to last 1 year without revenue. If you can access to that funding where you can last for a year, then I would say that there's no risk because the cost is so cheap, the processing fee is so cheap. In some cases, I think it's waived, and there is no repayment penalty. So if I'm a business owner, and what we have personally advised our clients is that take the money, roll first. You know, you may not use the whole sum, right? Because it's going to last you for 1 year. We don't expect it, hopefully it does not, you know, this COVID is not going to last for 1 year, right? So if you prudently take for 1 year as a buffer, whatever you use, you have already paid down in terms of installment. And the balance you can make repayment to the lender with no prepayment penalty. So I think that is the most logical, smartest financial decision that you can make if you are qualified for the loans.
Okay. All right. Thanks all. So I guess the questions are good. Hope the answers are good as well. Anyway, I'll send the survey form together with the slides. So if there are still any burning questions, feel free to leave them on and we will get back to you accordingly. So, okay. Thanks again. I think this is it. Stay safe, everyone. We hope to see you this Friday for our next session on Landscape of Government Grants 2020 by SME Center. All right, then. Thank you all.
Bye.
Bye-bye.